Welcome back. We're diving deep today, really trying to cut straight through the noise surrounding the AI economy.
Yeah, and more than just AI, right? We're looking at these massive forces, capital, geopolitics, tech, and how they're aggressively, reshaping everything, business, careers.
Absolutely. And it demands that you, listening, really pay attention. We're talking fundamental shifts in job security, what things cost.
That's the core tension we saw in the sources, isn't it? This kind of split in the economy. You've got one part supercharged by AI investment, just booming.
And the other part,
The other part is really feeling the pinch. High interest rates, tariffs, new regulations. It's a different world. We'll get into how tech giants are, maybe surprisingly, reacting to policy pressure.
where consumers are really showing the strain in their wallets.
Exactly.
So our mission, as always, is to take this pile of complex stuff and just pull out the critical insights for you fast. And we are kicking off with, honestly, maybe the most important signal for any skilled professional right now. Accenture just put a very, very blunt price tag on what happens if your skills lag behind. Okay, let's unpack this. So Accenture, global consulting giant.
Yeah.
They've just announced a plan to, well, cut staff who can't be retrained on AI fast enough.
The CEO, Julie Sweet, she used this phrase, exiting on a compression timeline.
Compression timeline. Wow. Sounds urgent.
It is. And what's really striking, the key signal here is they're doing this while growing. This isn't a recession thing.
Right. They reported, what, 7% revenue growth?
Yeah, healthy growth.
Yeah.
And they pinned it specifically on massive client demand for, guess what? AI deployment.
So they see the future, it's AI, and they're basically swapping out human capital now to get ready for it.
That's exactly it. It's a strategic reshuffle, even during good times.
And the scale of their investment in new skills is just wild. They've already upskilled, get this, 550,000 workers on generative AI basics.
500,000 people. That's staggering.
And they plan to hire 77,000 AI and data pros in 2025. That's almost double the number from just 2 years back.
Okay, wait. If they're reskilling 550,000 people, why also the cuts? Does that mean the training isn't enough, or?
That's the million-dollar question, isn't it? It kind of suggests two things. Either the bar for being AI ready is moving incredibly fast, maybe faster than they can train.
Or maybe some current roles just aren't compatible with where things are headed. The skills needed are fundamentally different.
It feels like a bit of both. And the money side of this, the calculation, is fascinating. Accenture expects over $1 billion in savings from this whole optimization program.
Which includes the severance, the job cuts.
Right. And they plan to reinvest all of that $1 billion saved immediately back into the business, presumably into more AI capability.
So it's a calculated hit now for a long-term gain, paying for the right future skills.
It's the playbook. You see it everywhere in future corporations right now.
And that playbook, it's being heavily influenced, maybe even written by the AI engine itself. You have to look at NVIDIA.
Oh, yeah. The chip maker, they're not just selling the gear anymore, are they?
Not at all. They're basically acting like the biggest venture capital firm for the entire AI ecosystem. It's incredible.
The centrality is just unmatched. We saw details this week. They've committed $100 billion into OpenAI.
$100 billion. And that's just one piece. Add on, what, $5 billion into Intel? Big stakes in infrastructure players like CoreWeave, Wave.
It's spreading bets everywhere.
If you just look at their balance sheet, it tells the story. Their investments in private companies, the non-marketable equity stuff, it jumped from $1.8 billion to $3.8 billion in 1 year.
Wow. But hang on, isn't that a huge potential conflict of interest? They're funding their own major customers. They're essentially picking winners among the AI models.
That's the tension, absolutely. Are they a supplier or an investor? Or both? They're using their massive cash flow to buy influence, gain insight,
And just cement themselves right at the absolute center of this whole AI universe, controlling supply and reading the demand signals because they're funding the demand.
It's an incredibly aggressive strategy. And interestingly, it contrasts so sharply with how, say, the ultra-wealthy are positioning themselves.
Right. We saw that survey of family offices, the private investment arms for the super rich.
Yeah. They seem much more cautious about jumping directly into AI startups.
What are they doing instead?
Mostly getting exposure through public markets. The survey showed like 52% prefer public stocks or ETFs, those baskets of stocks.
Okay, so safer bets, more transparency.
Exactly. Compared to only 25% who are directly investing in those volatile private AI startups, they seem to trust public valuations more.
Makes sense. Less opaque.
But they're also making smart secondary bets. About 38% are investing in companies using AI to boost their own productivity.
Ah, the downstream beneficiaries.
Precisely. And notably, they're planning to be overweight in energy providers.
Because all those AI data centers need massive amounts of power.
You got it. That's the savvy way to play the boom ride the wave without necessarily taking on the direct startup risk. Bet on the infrastructure, the energy.
That energy theme, that need for resources, it transitions us perfectly into the global friction we're seeing. Because these aggressive policies, they're creating sparks everywhere.
Yeah, not just in data centers, across global trade, critical supply chains. We're seeing what feels like a new wave of major tariffs.
A great tariff wave, yeah. And it's hitting some really critical sectors head on.
Like pharmaceuticals. President Trump announced these huge 100% duties on branded or patented drug imports starting October 1st, unless the drug makers commit to building plants right here in the U.S.
The reaction was pretty immediate, wasn't it? Asian pharma stocks took a hit.
They did. Daiichi Sankyo, Chugai Pharma. And the warnings came quickly, too. Groups like AARP, even the J&J CEO, Joaquin Duato.
What are they worried about?
Disrupting supply chains, basically. Driving up costs for consumers and potentially making existing drug shortages even worse.
It's that classic trade-off with protectionism, right? You try to boost domestic industry.
But you risk access and affordability for consumers. It's a high-stakes gamble.
Although we saw a very direct, immediate benefit for one domestic industry. Heavy trucking.
Right. A new 25% tariff on imported heavy trucks and Boom stock in PACCAR, they own Peterbilt and Kenworth.
Jumped up. Why?
Because their American-made trucks were suddenly much more competitive. They used to be, what, $8,000 to $10,000 more expensive than trucks coming in from Mexico?
And the tariff just wiped out that difference overnight.
Instantly leveled the playing field, from PACCAR's perspective. A clear policy win for the domestic producer there.
Geopolitics keeps getting tangled up with tech, too. Look at the whole TikTok saga.
Oh, yeah. Complicated doesn't even begin to cover it. So President Trump approved this deal via executive order, aiming to keep TikTok operating in the U.S.
It's this really elaborate structure they've proposed. VP J.D. Vance put a value on it, like $14 billion.
Around that, yeah. ByteDance, the Chinese parent company, would keep less than 20% of this new joint venture.
And who's running the show?
Well, Oracle is supposed to handle security, the cloud services, and then you've got major investors like Silver Lake and this entity MGX controlling a big chunk, like 45%.
Okay, but here's the catch, right? China still has to sign off on this.
That's the massive cliffhanger. Beijing has been, as the reports say, conspicuously quiet, just silence.
And the core issue, the whole reason for this drama, is national security. Who actually controls the algorithm?
Exactly. That's the heart of it. What content gets pushed to 170 million American users?
Yeah.
Is it influenced by Beijing? The deal structure tries to address that with Oracle's oversight, but...
If China doesn't approve that specific oversight, the control question remains murky.
Totally ambiguous. It's this high-stakes game of chicken over data, influence, and frankly, youth culture.
Meanwhile, other tech giants, the domestic ones, are facing their own regulatory heat, leading to, well, a really seismic policy shift internally. Here's where it gets really interesting, because this feels like it changes the very foundation of how we get information online.
It really does. We're talking about Alphabet, Google. They seem to be actively pivoting away from prioritizing factual accuracy.
Which was their mantra since, 2016 through the pandemic.
Yeah, that was their public stance, right?
Combating misinformation.
That was the policy framework. And now they're shifting hard towards protecting free expression instead.
What does that look like in practice?
Well, it's pretty profound. Google seems to be stepping back from being the judge of what's true. Look at YouTube. They're allowing accounts previously banned for things like COVID-19 misinformation or 2020 election claims.
People like Steve Bannon, RFK Jr.'s campaign.
They can now apply to get back on the platform. And Google also ditched that claim review feature in search results, the little fact-check snippet.
Why the change? Is it just giving up? Or is it strategic?
It seems strategic, driven by pressure. Alphabet's top lawyer, Daniel Donovan, actually sent a letter to Congress stressing their unwavering commitment to free expression.
Okay.
And he specifically pointed out that Google had resisted pressure from the Biden administration to remove certain content.
So they're using the regulatory scrutiny as cover, almost, to publicly say, look, we're platforms for speech, not arbiters of truth.
That seems to be the move, shedding the liability maybe, but the consequence is huge.
Yeah, if the world's biggest search engine and video platform step back from prioritizing accuracy.
It puts a much bigger burden on you, the user, the investor, everyone, to figure out what's reliable and what's not. The information environment just got potentially a lot messier.
Okay, let's shift gears now. Let's talk about how this all feels on the ground level, particularly in retail and for the consumer. We mentioned that sharp divide in the economy earlier.
Yeah, that bifurcation. It's really visible in retail earnings right now. You've got the AI sector flush with cash, almost indifferent to interest rates.
Right. And then you have the rest of the economy, the consumer-driven parts, which are super sensitive to rates and really struggling.
You saw that split perfectly in two earnings reports this week. First, the success story, Costco.
Always seem to do well.
They beat their Q4 earnings, beat revenue estimates. Growth came from those sticky membership fees up 14%, partly due to a fee hike, but also attracting younger members.
And e-commerce was strong too.
Up 13.5%. Plus, they cleverly used their private label brands, Kirkland Signature, to absorb some of the impact of higher tariffs on imported goods, keeping prices down for shoppers. Smart move.
Okay, so Costco's humming along. What's the other side of the coin?
CarMax, the used car retailer, their stock just crashed. Down 19% after really disappointing Q2 earnings.
Missed expectations by a lot.
Significantly, yeah. Both earnings per share and revenue. It just reflects that broader pain in consumer spending, especially on big-ticket items.
Used cars, houses, anything that usually involves taking out a loan.
Exactly. High interest rates, the higher cost of borrowing it, bites hard in those sectors. That's where you see the direct impact of inflation and tight credit policies.
And that pain, that sensitivity to cost, it's not just about physical goods. It's boiling over into experiences too, like concerts. There's this big public fight over ticket prices.
Oh yeah, between Live Nation's CEO, Michael Rapino, and the music producer, Jack Antonoff.
What's the argument?
Well, Rapino claimed concert tickets are actually underpriced, citing an average of like $72.
Okay. And Antonoff?
He basically called that ridiculous. He argued the real problem is the resale market, where tickets get flipped for way above face value. He called it chaos and exploitation.
What's his solution?
Make it illegal to sell tickets above face value, give control back to the artist, build consumer trust again.
This is all happening just as the FTC is suing Live Nation and Ticketmaster, right?
Perfect timing, or maybe not so perfect for Live Nation. The FTC suit accuses them of illegal tactics, basically saying they kind of quietly work with scalpers to inflate profits through the resale market.
Wow, so it's corporate strategy hitting consumer anger and regulatory action all at once? The cost of having fun is getting political.
Definitely. But on a more upbeat retail note, there's a really interesting turnaround story happening with Claire's.
Claire's? The tween accessories place, weren't they bankrupt?
They were. But this private holding company, Ames Watson, bought them out of bankruptcy for about $140 million. And their insight was brilliant. They called it a broken business, not a broken brand.
Meaning the name recognition, the nostalgia was still strong.
Exactly, especially with millennial moms who grew up with it. So their revitalization strategy is smart. They're focusing on the one thing you can't do online.
Which is?
Getting your ears pierced. They're making that in-store experience central, creating a dedicated piercing excellence team.
Okay, leaning into the physical advantage. What else?
Overhauling merchandise, updating about 30% of products, adding exclusive lines, improving things for staff, better pay, better benefits, and that targeted marketing hitting the nostalgia button for moms.
It's a great case study, actually, how brick-and-mortar retail can still thrive if it offers something unique, something experiential.
Absolutely. And that theme of clarity, of value, it also applies to personal finance. We pulled one little nugget for you on financial advisor fees because it's often quite opaque.
Yeah, I saw that stat. Something like 56% of people don't actually know how their advisor gets paid, or they think it's free.
Which it never is, right? Everyone gets paid somehow. Broadly, there are two main ways advisors make money.
Okay, what are they?
First is commissions. That's a one-time payment for selling you a specific product, like an insurance policy or a mutual fund. The potential issue there is a conflict of interest. Are they recommending it because it's best for you, or because it pays them well?
Right, the incentive problem. What's the alternative?
Being paid by fees, this is generally seen as more transparent. The most common fee model used by maybe 72% of advisors is assets under management, or AUM.
How does that work?
They charge a percentage of the total assets they manage for you, typically around 1% per year, taken directly from your account. It generally aligns your goals. If your investments grow, they make more.
But of the downside?
It might not work well for people just starting out who don't have a lot of assets to manage yet. That 1% might not be enough for the advisor, or the minimum asset level might be too high.
Are there other fee models?
Yes, but they're much less common. Things like a flat dollar fee per year, which is super transparent and predictable, but can feel like a big chunk of money up front.
And even rarer.
Things like subscription fees, paying hourly, or paying per engagement for a specific plan. These are great for younger investors or DIY types who just need a one-off checkup or specific advice.
But hard to find an advisor who works that way.
Very hard. Less than 1% of advisors use those models, unfortunately. So transparency is still a challenge.
Okay, so we've covered a lot of ground. The AI capital flood, the geopolitical friction, the tariffs, the consumer feeling the squeeze. What's the big takeaway here? What does this all mean when you put it together?
Well, what we've really witnessed across all these sources is just aggressive fundamental restructuring. Everywhere you look.
Whether it's Accenture demanding new skills from its workforce.
Or the government using tariffs to try and force drug manufacturing onshore. Or even the fight over how much a concert ticket should cost.
Big forces, corporate, political, are actively reshaping markets.
They really are. And the underlying trend seems to be this. Efficiency and protection are winning out. Think about the drivers of the AI boom, the rationale for tariffs. Those are being prioritized.
But often at the expense of other things.
Often at the expense of, say, consumer access, affordability, and maybe even the integrity of the information we all rely on.
Which brings us right back to that Google pivot, doesn't it? The biggest tension point, maybe. Governance and information in this new era.
Exactly. So here's the thought to leave you with. If the tech giants, the platforms like Google, feeling regulatory heat, are now shifting their core mission away from trying to promote accurate information towards ensuring free expression.
Yeah.
How prepared are we, as citizens, as investors, as just people trying to navigate the world? How ready are we for an increasingly personalized but also increasingly unfiltered digital reality?
That is the challenge, isn't it? For every single one of us moving forward,